On November 23rd, 2025, Goldman Sachs made a move that went unnoticed by most, but which signals the silent beginning of a possible collapse. On that date, the bank sold over $847 billion in U.S. Treasury bonds. Without warning, without headlines, without fanfare, just a cold, calculated move recorded behind the scenes of the financial system. And this wasn't a portfolio adjustment. It was a strategic withdrawal, made at the exact moment when long-term interest rates skyrocketed and systemic risk reached a new level. While most still believe that U.S. Treasury bonds are the safest asset in the world, the planet's largest banks are quietly fleeing. And this isn't just theory, it's a visible trend in official data, which you'll understand in a few minutes. By the end of this video, you will clearly see the stage of collapse we are in, and why the financial elite is already taking a stand. Understanding this today puts you light years ahead of those who are still distracted. It all began without any press conference, no official statement, no headlines, but the numbers were there, clear as day, for anyone who knew where to look. Goldman Sachs, one of the largest and most influential investment banks on the planet, did something unseen in decades. It drastically reduced its exposure to U.S. Treasury bonds, assets considered the anchor of the global financial system. But this wasn't a simple portfolio rebalancing, as hasty analysts like to label it. It was a strategic withdrawal, deliberate, surgical, and with precise timing. Amid rising long-term interest rates, the bank anticipated what many will still take time to realize. The supposed safety of U.S. Treasury bonds has become a disguised trap. Now, think about it. If Goldman Sachs, which has access to information, projections, and reports that you and I will never see, is selling off these securities en masse, what do they know that hasn't yet reached the news? That's the detail that almost no one notices. Because the real warning sign doesn't come from what they say, but from what they do. Goldman Sachs' track record shows that they don't play against the system. They operate within it and shape it. If they are moving, it's because the system is about to change, and that casts a shadow over the heart of the global monetary system. The blind faith in Treasury bonds as risk-free assets. You might think, but what if it's just a temporary strategy? This is where everything starts to change, because this decision came at a very specific moment, right after the most aggressive interest rate hike in the last 40 years, and at the height of instability in the sovereign debt market. Furthermore, the unrealized losses in banking portfolios had already been exposed since the collapse of Silicon Valley Bank. The entire sector saw what happens when interest rates skyrocket and long-term bonds melt down. Goldman Sachs saw this as a dress rehearsal for what's to come, and decided to exit the scene before the next curtain falls. What's most unsettling is the silence. No public justification, no interviews explaining the reason for the sale of over $847 billion. This seems insignificant, but it's not, because when the ship is too big to sink, whoever's at the helm doesn't shout. They quietly withdraw. And this withdrawal changes everything, because Treasury bonds aren't just an investment, they're the collateral of the financial system. Banks lend to each other based on them. Funds use them as collateral. Governments treat them as reserves. If Goldman is pulling away, the base of the pyramid starts to crack, and it doesn't stop there. These movements have a chain reaction. Global managers monitor every step of the Wall Street giants, and when the biggest one starts to move, the others follow. And that's exactly what has begun to happen. But let's take it one step at a time. Because Goldman wasn't the only one. He was just the first to act coldly. What came next reveals something even bigger. A coordinated movement of so-called smart money, which is quietly abandoning the roles that underpin the narrative of security in the markets. And that's exactly what we're going to see in the next topic. If it were just Goldman Sachs, it would already be worrying. But what we're seeing is something much bigger. It's the so-called smart money, the most informed, connected, and influential capital on the planet, making a silent exit from U.S. Treasury bonds. And when smart money starts to run, the average investor needs to pay attention, because these movements are not random. They are preventive. Over the course of just 12 months, central banks, sovereign wealth funds, insurance companies, and large financial institutions have disposed of more than $847 billion in U.S. government securities. This is the largest volume ever recorded since the Treasury began regularly monitoring these flows. And most impressively, this is happening without most people even realizing it. Here's the detail that almost no one sees. This exit doesn't happen with fanfare. It's done in a phased, distributed way without causing panic, precisely to avoid waking up the rest of the market. The big players don't shout fire. They just leave through the back door, calmly, while there's still time. You didn't see headlines talking about this? Because the media's focus is on the micro-tensions of everyday life. The CPI, Parliamentary Commission of Inquiry, the payroll report, Powell's speech. Meanwhile, the outflow of institutional capital happens right before everyone's eyes, but camouflaged within the lines of public spreadsheets. It's a technical movement, but with global implications. Data shows that American financial institutions have drastically reduced their exposure to long-term securities, especially those with maturities exceeding 10 years. This category, which should be the foundation of security in the system, has become a deadweight, a hidden risk. A time bomb ready to explode with the slightest wrong move in monetary policy. Global funds like Bridgewater, BlackRock, and Vanguard have also begun to reduce their positions, and in closed conferences, directors speak openly about structural repricing of sovereign risk. And this language may sound technical, but it translates a simple reality. They no longer trust American bonds as they once did. And we're not talking about predictions, but concrete actions. Billions of dollars are being reallocated to shorter duration securities, gold, private assets, and even positions outside the traditional financial system. This seems small, but it's not. It's a clear sign of a structural loss of confidence. Undeclared, but practiced. Some analysts call this diversification. But you don't diversify by exiting with nearly $1 trillion from an asset that is supposedly still the safest in the world. This isn't a technical adjustment. This is defense. This is protection. This is a sign that the big players are preparing for something that hasn't yet been priced in. The mass exodus is creating a vacuum. With less demand, the Treasury has been forced to pay increasingly higher interest rates to attract buyers. And the higher the promised yield, the higher the cost of debt. And the higher the cost of debt, the closer we get to the trap we will discuss in the next topic. The point is simple. Smart money is anticipating events. They've seen this movie before. They know how it ends. And while the average citizen believes everything is under control, the moneyed elite are building the emergency exit, brick by brick. But why, exactly, have these securities become so risky? The answer lies in something that has changed the entire mathematics of the system: high interest rates. And that's where the problem transforms into an invisible threat within bank balance sheets. Let's talk about that now. For decades, U.S. Treasury bonds were treated as the safest asset on the planet. They were considered risk-free, a kind of safe haven in times of turbulence. But this concept began to crumble the moment interest rates rose faster than at any other time since the 1980s. And this is where everything begins to reverse. What few people understand is the direct mathematical relationship between interest rates and bond prices. When interest rates rise, the value of older bonds, which pay less, plummets. It's simple. Nobody wants to buy an old bond paying 2% if they can get a new one paying 5%. The result? The price of older bonds falls, and those holding these bonds start to suffer losses. And who is holding on to these assets? The banks, the pension funds, the insurance companies, institutions that, in theory, should be the most stable in the system. But now they are sitting on gigantic unrealized losses, which haven't come to light yet, only because accounting allows them to hide the whole if no one is forced to sell. But the system doesn't work in theory. It works on trust. And when a bank, even a small one, is forced to sell its securities at a loss, the house of cards begins to wobble. That's exactly what we saw in the collapse of Silicon Valley Bank. Interest rates rose, securities depreciated, the bank had to sell, and it imploded in days. The cruel irony is that these safe securities were precisely the trigger for the risk. They only seemed harmless while interest rates were low. But now, with the Fed's quantitative tightening policy, liquidity has evaporated and structural fragility has been exposed. It's like a crack in the concrete that no one sees until the day the building collapses. And it's not an isolated problem. Recent studies show that the American banking system as a whole is carrying latent losses exceeding $1.3 trillion. That's right, more than $1 trillion in hidden losses, simply by holding securities that have become negative yield traps. These losses haven't exploded yet because the market is pretending that banks will be able to hold these securities until maturity. But this is based on a fragile premise that there will be no panic, no bank run, and that no one will need emergency liquidity. A premise that, historically, never holds up for very long. Furthermore, the Fed is cornered. If it continues raising interest rates to combat persistent inflation, these losses will widen even further. But if it backs down now, it loses credibility and fuels the collapse of the dollar. It's the classic dead end, and the debt spiral begins to accelerate. This dynamic has transformed safe haven assets into catalysts for systemic risk. It's the same role that subprime mortgages played in 2008, seemingly solid assets, but carrying hidden poison in the details. And this time, the poison is on a much larger scale. What does this mean in practice? It means we are witnessing a silent collapse of confidence in American debt. It's not that the bonds will cease to exist, but their status as a risk-free asset is being eroded, and the entire global financial system depends on this illusion. And when bonds lose that aura of security, the consequence is straightforward. The cost of refinancing the debt explodes, which leads us to the next stage of the crisis, the American debt trap. Let's understand now why this spiral has already begun. On paper, the United States government is still the most powerful entity in the world, but in practice, it has fallen into a mathematical trap with no easy way out. The American public debt has surpassed $36 trillion, a number so large that it no longer causes shock. But it should, because this debt is not just high. It is unsustainable. In 2025 alone, the U.S. Treasury spent over $1 trillion just on interest payments. That's right, over $1 trillion a year just to keep the machine running, without reducing the principal, without paying anything off. just to avoid defaulting. And that number grows every month as old bonds mature and need to be replaced by new ones with higher interest rates. This is the essence of the debt spiral. The more you owe, the more interest you pay. And the more interest you pay, the more debt you need to take on. It's a race against time and against solvency itself. This trap has destroyed empires in the past, and now it's trapping the greatest power of the modern era. And here's the detail that almost no one notices. The United States can't simply pay off the debt. They are forced to constantly refinance it. The average maturity of the bonds is less than 6 years. This means that trillions need to be rolled over every year. And each new issuance depends on investors willing to buy an increasingly risky asset. But the buyers are disappearing. The smart money has already left. Foreign investors, whom we will discuss in the next section, are also jumping ship. This forces the American government itself to buy its own debt. How? Through the Federal Reserve. The same central bank that claims to fight inflation is the one that, in the shadows, sustains the system with the printing press ready. This manipulation, known as debt monetization, has a cost, inflation. Not immediately, but inevitably. Because printing money to pay off debt is like putting out a fire with gasoline, and the signs have already begun to appear. Inflation, which should be under control, remains high, persistent, and widespread. The trap truly closes when the government can no longer raise interest rates, because that would make payments unaffordable, nor lower them, because that would fuel inflation and destroy the credibility of the dollar. It's a dead end, where each option worsens the problem it's supposed to solve. And the most dangerous thing is that this isn't in the official speeches. Congress is still talking about increasing spending. The White House is still presenting new programs. The Fed is still projecting a soft landing. But behind the scenes, internal reports already admit the fiscal trajectory is unsustainable. The bomb is armed. They just don't know when it will explode. History shows that no empire survives after losing control of its own debt. Rome, Spain, France, England all went through the same cycle. Growth, indebtedness, printing, collapse. Always the same pattern. And the United States is today in the final stages of this script. The debt trap is not an isolated event. It is the heart of the crisis. It is the point at which the system begins to consume itself. And meanwhile, the pillar that sustained global demand for American bonds is also crumbling. Foreign investors are quietly withdrawing. Let's now understand what is happening with China, Japan, and the other major creditors of the U.S. For decades, the Federal Reserve was seen as the ultimate arbiter of the global economy. When the Fed spoke, the world listened. But now, what was once a strength has become a weakness. The most powerful monetary authority on the planet is cornered by a dilemma with no clear solution: controlling inflation without bankrupting the government, or sustaining the debt without destroying the dollar. The problem began when interest rates, which had remained artificially low for more than a decade, needed to rise rapidly to contain runaway inflation in 2021. The Fed raised the benchmark rate to levels not seen since the 1980s. And this had a domino effect throughout the financial structure, from public debt to the pricing of private assets. But this interest rate hike wasn't without cost. Each additional percentage point represented hundreds of billions of dollars more in interest payments for the government. And now, with the debt exceeding $36 trillion, the U.S. Treasury is bleeding more than $1 trillion a year in finance charges alone. The burden of monetary policy has fallen directly on the currency issuer itself. This is where the Fed finds itself at an impasse. If it continues raising interest rates to curb inflation, it accelerates the U.S. fiscal collapse. If it starts cutting interest rates to ease the government's burden, it revives inflation and pushes the dollar toward devaluation. No matter which direction is chosen, the damage is guaranteed. The technical name for this is fiscal dominance. The real name for it is chaos. The detail that few realize is that the Fed has lost its room for maneuver. It no longer controls the game. It only reacts. Every monetary policy decision today is not a strategy. It's an attempt to contain damage, a patch on a leaky dam full of cracks. And every wrong move could be the trigger for a global crisis. Since the beginning of the monetary tightening cycle, the Fed has sold hundreds of billions of dollars in assets through quantitative tightening. The intention was to reduce liquidity to curb inflation. But the side effect was brutal. Bonds lost value, banks went into distress, and confidence in balance sheets began to crumble. At the same time, the interest rate cuts that the market expected did not come as quickly as promised. Why? Because the Fed is constrained. Cutting too much now could lead to the devaluation of the dollar, which, in turn, would accelerate imported inflation and erode the purchasing power of the population. And in an election year, that's political poison. Furthermore, the Fed can no longer rely on the old tactic of printing money. With each new cycle of artificial liquidity, the response from the real economy is weaker and the inflationary consequence is stronger. It's like a drug. The effect wears off faster and the dose needs to be higher, until the point where the system overdoses. Today, every decision by the Fed carries a systemic consequence. It's no longer about fine-tuning the economy. It's about choosing which part of the system you're going to sacrifice: the dollar, the banks, the government, or the people. And the scariest thing is that you can no longer save them all at once. Behind the technical pronouncements, internal reports already admit that the credibility of the monetary authority is in question. The market doubts the Fed's ability to maintain equilibrium, and when the market loses faith, the system begins to collapse from the inside out. First slowly, then suddenly. That's why the recent movement of international investors is so relevant. When even the United States' historical partners start to withdraw, the signal is clear. Confidence in the system is evaporating. And this leads us to the next topic. Let's now see how China, Japan, and other major holders of American debt are responding, and why this could accelerate the collapse of the dollar. For decades, the United States government relied on a silent trump card of foreigners financing its debt. China, Japan, Saudi Arabia, European central banks all accumulated treasury bonds as part of their reserves. It was a relationship based on trust, stability, and, above all, mutual interest. But this informal pact is unraveling. The shift began subtly, but the numbers don't lie. China has reduced its holdings of U.S. Treasury bonds to their lowest level in 14 years. Japan, traditionally the largest external creditor of the U.S., has also been reducing its holdings. Together, the two countries have already sold off more than $300 billion in U.S. securities in the last 18 months. And this isn't a one-off event. It's a clear trend. Major creditors are rebalancing their reserves toward more diversified assets, including physical gold, foreign bonds, and alternative currencies. The message is simple. Relying exclusively on the dollar is no longer a safe strategy. This is where everything starts to change. The detail that almost no one notices. This foreign outflow creates a gap that needs to be filled. And who is taking on this task? The United States government itself? Yes, the Treasury issues the bonds, and the Federal Reserve directly or indirectly buys them. A game of mirrors where the creditor and the debtor are the same. This process is unsustainable because it transforms the system into a closed loop. Without a real inflow of foreign capital, printing money becomes the only alternative to keep the state functioning. And every time a government tries to sustain its own debt by printing more money, the outcome is always the same: inflation, collapse, and loss of international credibility. Another factor that is often overlooked is the geopolitical shift. The trade war between the US and China, conflicts in the Middle East, and the formation of alternative economic blocs like BRICS are accelerating de-dollarization. Countries are seeking bilateral agreements in local currencies, creating parallel settlement systems that do not depend on the dollar. In other words, the world is preparing for a scenario where the dollar is no longer the central currency, and this directly impacts the US bond market. Without consistent external demand, the Treasury needs to pay more to attract buyers. And paying more means raising interest rates, which perpetuates the debt trap. Furthermore, the perception of risk has grown. The downgrade of the U.S. credit rating by independent agencies has triggered alarms worldwide. Even though bonds are still considered safe in major economics textbooks, the reality behind the scenes is different. The fear of a crisis of confidence is spreading. This movement is also visible in capital flows. Sovereign wealth funds and central banks are accelerating their gold purchases. In 2025, official gold purchases by governments hit historical records. This is no coincidence. It's protectionism. It's a silent flight. It's preparation for a scenario of monetary collapse. And the immediate consequence of all this is the strengthening of real assets at the expense of nominal assets. While bonds lose attractiveness, commodities, metals, and real estate gain prominence. The logic of global capital is being reconfigured, and those who understand this now are years ahead. The bottom line of this topic is straightforward. If the world's largest creditors are exiting American bonds, why should you still believe that everything is under control? This question is more than rhetorical. It points to what comes next. Because the next phase of the collapse ceases to be technical and becomes personal. And that's what we're going to talk about now. So far, it all seems like a dispute between giants: Goldman Sachs, the Federal Reserve, China, Japan. But what almost no one tells you is that, in the end, you're the one who will pay the price. Because when the financial system falters, it's not the banks that collapse first. It's your stability that crumbles. And the impact has already begun. With high interest rates and eroded confidence, mortgages have become more expensive. While it was once possible to finance a house for 30 years with rates close to 3%, new contracts now exceed 7%. This means that, for the same house, you pay double. Double. And this is not a prediction. It's the new reality in several regions of the United States and other countries that follow the same model. Furthermore, pension funds and retirement portfolios are loaded with securities that have become ticking time bombs. When these securities fall in value, the impact is directly felt by those who depend on them to live in the future. Retirements are being silently eroded. What seemed secure has turned into quicksand, and when confidence in the system begins to crumble, credit freezes. Banks become more restrictive, companies reduce hiring, investments are suspended, and unemployment begins to rise. This is already happening in sectors most sensitive to interest rates, such as construction, technology, and small industries. At the same time, inflation continues to put pressure on the cost of living. Food, energy, rent. Everything is going up, even with the promise that inflation would be transitory. The printing of money to sustain the debt has created a persistent side effect, loss of purchasing power. And those who suffer most from this are the base of society. This may seem distant, but it's not. It's in your bank statement, your grocery bill, your loan payment, your retirement plan. And what smart money has already understood is that you can't wait for the collapse to become visible in the newspaper headlines. When that happens, it will be too late to protect yourself. The big banks are getting ahead of the curve because they know how the cycles end. They study the patterns. They read the reports that aren't public. And that's why they sell earlier. They exit earlier. They position themselves earlier. And meanwhile, most people still believe that everything is fine because the system continues to function for now. But that's the most dangerous illusion. Systems break down silently until they break down spectacularly. And you need to understand that the time for waiting for magic solutions is over. The bill is coming due, and it won't be sent to Goldman Sachs. It will be sent to homes, to wages, to the savings of ordinary families. That's why information is now more valuable than ever. Those who understand what's happening can act. You can adjust your portfolio, protect your income, and get out of the line of fire. But those who ignore or underestimate it repeat the story of those who were caught off guard, and then ask, how come nobody warned us? Now that you've seen the complete cycle, the real question is, what stage are we at? And more importantly, what's still to come? Because the signs are clear, and the clock is ticking. But before it reaches zero, there's a decision only you can make. Keep watching or start taking action. The signs are there. Clear, repetitive, historic. The collapse of confidence in American bonds is not an isolated event. It follows the same script we saw in Rome, Spain, France, and England. The same sequence: excessive debt, capital flight, currency devaluation, social crisis. The only difference now is the scale, because never before in history has there been so much money, so much global interdependence, so much fragility hidden beneath the appearance of stability. And yet, most people still live as if nothing is happening. The question remains, what will you do with what you've just learned? Will you file it away as a curiosity, or will you turn it into action? Because those who anticipate survive. Those who wait for the headline become statistics. This isn't about predicting dates or creating panic. It's about recognizing patterns. And the pattern that's emerging doesn't end well for those who ignore the warnings. Now is the time to reassess, adjust, and protect yourself while there's still time. If this content opened your eyes, subscribe to the channel now, turn on notifications, and leave a like. This shows YouTube that this type of content needs to reach more people. And it guarantees you access to the next video, where we'll show why the dollar collapse has already begun and how the elite are protecting themselves with real assets. Because understanding is only the beginning. Taking action is what separates those who lose from those who prosper.